Have you ever wondered if the interest you're earning on your savings or investments is really helping you grow your wealth? It's not enough to just look at the stated interest rate. You need to consider inflation. That's where the real interest rate comes in. It's a crucial concept for anyone managing money, and today we're going to break it down. So what exactly is the real interest rate? Simply put, it's the interest rate adjusted for inflation. It represents the true return on your investment, or the true cost of borrowing in terms of purchasing power. Think of it this way. A 5% interest rate sounds good, but if inflation is running at 3%, you're not actually gaining as much as you think. The real interest rate tells you how much your money is actually growing after accounting for the eroding effects of rising prices. Why is this relevant, especially for a U.S. audience? Well, the U.S. economy, like most, experiences periods of inflation. Inflation isn't necessarily a bad thing in small doses, but when it rises significantly, it eats away at the value of your money. Understanding the real interest rate helps you make informed decisions about saving, investing, and borrowing. It lets you see if your returns are actually outpacing the loss of purchasing power. For example, if you're saving for retirement, you want to ensure your investments are earning a real return that will maintain, or even increase, your lifestyle in the future. Similarly, when taking out a loan, a lower nominal interest rate isn't always best if inflation is also low or even negative. Let's look at how it works with some simple examples. Imagine you deposit $1,000 into a savings account earning a 4% annual interest rate. After 1 year, you'll have $1,040. That seems straightforward, right? But let's say during that same year, inflation was 3%. This means that the things you could buy with $1,000 a year ago now cost $1,030. To calculate the real interest rate, we use a simple formula. Real interest rate equals nominal interest rate, inflation rate. In this case, the real interest rate is 4%, 3% equals 1%. So, while you earned $40 in interest, the purchasing power of your money only effectively increased by $10. You haven't really gotten ahead by much when factoring in rising prices. Now, let's consider a scenario with higher inflation. Suppose you earn that same 4% on your $1,000, but this time inflation jumps to 6%. Using the formula, the real interest rate becomes 4%. 6% equals minus 2%. This means your money actually lost purchasing power. You ended the year with $1,040, but those $1,040 can buy fewer goods and services than the original $1,000 could. This is a crucial point. A positive real interest rate is what you generally want when saving or investing. What about borrowing? Let's say you take out a loan with a 7% interest rate and inflation is 5%. The real interest rate is 7%, 5% equals 2%. This means the real cost of borrowing is 2%. While you're paying 7% in interest, the inflation is effectively reducing the real value of the money you're repaying. This is why, in times of high inflation, borrowers can sometimes benefit from fixed-rate loans. The real interest rate isn't a fixed number. It fluctuates based on changes in both the nominal interest rate and the inflation rate. The Federal Reserve, or the Fed, plays a significant role in influencing the nominal interest rate through monetary policy. They can raise or lower interest rates to control inflation and promote economic growth. Inflation, on the other hand, is influenced by a variety of factors, including supply and demand, energy prices, and global economic conditions. It's important to note that there are different ways to calculate the real interest rate. The formula we used is a simplified version. More complex calculations might use different inflation measures, like the Consumer Price Index, CPI, or the Personal Consumption Expenditures, PCE, price index. Understanding the real interest rate can help you make better financial decisions in several ways. First, it can guide your investment choices. You might prefer investments that offer a positive real return, even if the nominal return is relatively low. Second, It can help you evaluate loan terms. A lower nominal rate isn't always the best deal if inflation is high. Third, it can help you understand the overall health of the economy. A negative real interest rate can be a sign of economic weakness. In summary, the real interest rate is a vital metric that reveals the true return on your investments or the true cost of borrowing, taking inflation into account. It's calculated by subtracting the inflation rate from the nominal interest rate. A positive real interest rate is generally desirable for savers and investors, while borrowers should consider the real cost of borrowing in addition to the nominal rate. By understanding this concept, you can make more informed financial decisions and protect your purchasing power. Remember, this information is for educational purposes only and should not be taken as financial advice. Always consult with a qualified financial professional before making investment decisions.